guys, welcome back to Markets with May. It is Wednesday, February the 2nd, so 2/2/22. And it's also Groundhog's Day, so hopefully Puxatawny Phil did see his shadow, so let's see how that goes. The markets started the day kind of in the green, then in the red, then back in the green. And really, if you think about it, Google is such a gigantic part of the markets. The only thing that I would use for hedging right now is the Russell. And that is despite the fact that I think that ultimately the Russell is increasingly becoming undervalued because so many of the companies that have been reporting are in fact reporting not just pretty strong numbers, but also that they will be very acquisitive going into the next year. Now, I just wanted to show you, this is kind of what the market looks like right this minute. You have Google up 8.7%, and I believe they are also going to split their stock, which typically does have folks running up the stock a bit. In fairness, given these new numbers at $3,000, it's more or less trading in line with its earnings growth. And some people are like, well, how much is it really going to grow? And I'm like, well, do you understand what Google does? So I would just be cautious if anybody wanted to short Google or sell their Google into this. I actually think that Google is probably as safe as Apple, if not even slightly more safe in some ways. Depends how you think about it, but I'm a huge fan of Google and always will be. We do have some economic data still on jobless claims coming in at the end of the week, but this is not a week about economic data. And then we do still have some pretty big earnings reports coming in. And it's not so much that the other companies within large cap are less important. It's just that these three kind of tend to move the markets quite a bit. Amazon, I think, sometimes can impact all of consumer. It's traded down so much, and at the same time, two of its businesses are not that straightforward to just feel confident about. So I'm not necessarily suggesting that people take positions on Amazon. With Facebook, we had said, hey, go with some bull call spreads. It's more or less retraced back to that 320 level. If you want to do like a Hail Mary lottery ticket, go for it, but really take profits before earnings, because I do think that the market is acting very bizarrely. Now, I do want to show you, I do a personal rating on all the companies I listen to. As you guys know, I listen to about 400 companies per quarter. And, you know, my ratings are not like other people's, because most people are doing ratings relative to what the stock is valued at or any other number of metrics. I literally just listen to call and try to figure out, did the company report a good quarter, or is there something weird going on? So these are my little ratings because I have to amuse myself while I'm listening to 400 calls. But essentially, these top two categories, these companies are growing top line, and they're also bringing it all the way down to net income, meaning everything is going like this for them. They are able to increase sales and also improve their operating margins. And the ones with the little party hat, they do it in a way that doesn't even make sense. So for example, I'm seeing like top line growth of 20% quarter over quarter, year over year on the quarter. So December 2022 versus December 2021. Sorry, December 2021 versus December 2020. Sorry, we're reporting the fourth quarter. And then on top of it, I'm seeing margin expansion. And I do adjust for situations where you just have oddities in 2020. So like, for example, I'm not giving oil companies extra credit because they're essentially, with oil going from 30 to on its way to 90, reporting a negative quarter in 2020 and then actually crushing it in this year. So I'm not, those are all going in my thumbs up category. Then I would say that relative to times in the past, I'm seeing way more differentiation. Meaning, I usually don't have in the first 150 companies that report earnings this many in the I have no idea what's going on sort of category, or in the wow, that wasn't great, I'm going to need to see another quarter before I touch this either way, long or short, or that was the worst quarter I have ever seen. Really need to try to work on things a little bit. And this quarter, I am definitely seeing that differentiation. On the ones at the top, because I do think we're going into a period where valuation becomes relevant again, when these up here get cheap, I like to buy them because, quite frankly, these companies up here at the top all have enough cash to buy their own stock. And I did actually see that. I saw net income in some of these names Revenue was up aggressively. Net income was up better even than revenues. So you got margin expansion, meaning for every dollar, it took them less dollars to make that dollar. But additionally, what I saw was because they had bought back shares, by the time you then divided that net income by the number of share count, you had an expansion in the earnings multiple itself. So that is crazy, crazy good. I suspect that through 2022, we're going to see more of this among the leaders within the market space. And it's going to really either make some companies ridiculously undervalued and therefore a great play for everyone to own for the long term. That said, I still think that we got to get through some of this craziness. We've got the OPEC meeting, not a lot of news flow yet, but we'll see news flow come out of it. But as funny as it was, the LNG commentary from Reuters is already acting like somehow LNG to Europe is resolved. And these are some of the quotes that I took from the article. David likes to try to keep me up on things, and I love it. Send me stuff. I think it's awesome. Use the Discord. I want to see what you're seeing because I can't see everything for sure. But the article was really kind of suggesting that the LNG issues are resolved a bit and that somehow demand will subside slightly to lower this tremendous oil price and nat gas price that we've been seeing globally. And these are some of the quotes. LNG demand overall may cool as winter heating season comes to an end. I have no idea how anyone would make that call in the middle of January unless they somehow are friends with God and have a hotline to him. You know what I mean? It doesn't even make any sense. It sends a signal that Asia had full tanks and we're not expecting to be big buyers. Not sure about that, given that the coal price has gone through the frickin' roof and LNG's major usage is the utility companies. Plus, there are other concerns I think that are going on in Asia. It doesn't quite make sense to me that someone would make a call like that, but maybe it's hopefulness. I don't know. Warmer than expected weather in Asia. That is potentially true, although it's still a little early to call that. And healthy stockpiles last month helped swing LNG cargoes to Europe. China, look, I want you to see something. See how China is not an exporter of LNG in 2019 to Europe? That actually hasn't changed. Okay, so I'm really confused by some of this. China's Unipac offered to sell up to 45 cargoes of LNG this year. I'd be really surprised if that continues, and if they did do that, they're really doing it to get an amazing price on LNG. The only real thing that changed from yesterday to today, in my opinion, is that the groundhog saw its shadow. So maybe the groundhog has a lot more impact on the market. I could end up being wrong on this, but it's not that I think that forever the LNG price will be elevated. It's just that nothing changed from yesterday to today, and it's quite risky to make this sort of article and call because we don't know what OPEC is going to say. And, it's just very, very awkward, and we don't know how Russia will react to whatever OPEC says or does right at this moment. So I'm really shocked that this is the news flow for today. I think the article would be more newsworthy tomorrow, but this is out there. It is what it is. Let's see how it goes. I do think it's always really good to kind of keep in the back of your head the things you want to own versus the things that you're not sure that you want to own. Remember, for the U.S., nat gas prices have increased by about 300%. It's what it's showing on most companies that have to buy nat gas. They're showing a 300% increase in the price, in their energy price. So even if it cools a bit, most of the companies that in the oil and gas industry in the United States benefit. And also, if you'll look at how much in 2019 Russia supplied in BCM versus what the U.S. does, this is a net positive for the United States. If we sit there and redirect our energy to Europe, fantastic. For nat gas prices, terrible for the U.S. consumer, especially since we just released a bunch of reserves in the month of November to try to get oil and gas producers to do a little bit more on the production side. So just realize all of that is going on in the background. I would still say that probably the least volatile names for you to own are these three. These three benefit whether we're selling it in the U.S. or whether we're selling it overseas, because guess what? The end of all of these pipelines is a port that then takes it to Europe, and in some cases, these guys also have tankers, such as Kinder Morgan. So, if you want to kind of stay out of the fray a little bit, just buy these for their gigantic dividend yield anyways. Don't try to get too cute with the options market on these, because I just think why they're not really that expensive from a dollar value basis relative to the risk that you would take on doing it in the options market. Also, I would say, whereas I'd been positive XLE, I would be more constructive ExxonMobil right now, because the dividend yield is very juicy and the oil price would have to come down a whole lot for it to have any kind of risk to this 4.6% dividend yield. And, you know, that's just probably a better play than the XLE right this minute, since ExxonMobil is one of the largest companies anyways within the XLE. I also want to just reiterate, I want to move down to here, because sometimes when you have these weird news days, I like to take a half a step back and really look at what happened in January. So huge sell-offs in January. Some companies still have risk going into earnings, a little bit scary. Other companies have already reported earnings, so talking about them and seeing how they're recovering. Like for example, Microsoft down 8%. It's not necessarily the cheapest company, but if you're trying to own Microsoft, it did come in for sale. So you can pick some long-term stuff there. But the two that I want to highlight today are two, when I looked through how much they were down versus what any kind of risk there is to them reporting earnings in the coming month, they really stuck out to me, and that's American Tower and Applied Materials. And I'm going to go through American Tower first, because that one you don't necessarily play in the options market. And full disclosure there, I have been in American Tower for over a decade, so I am a huge fan of this company. American Tower is essentially a REIT. No, it's not essentially REIT. It is a REIT, period. It's a real estate investment trust, but unlike others, its properties are towers. And this company almost never has a dividend yield above 1%. Currently, it's trading at 2.2%. And I looked at some of the analysts that were saying probably the dumbest stuff I've ever seen in my life associated with it. And it really just had to do with, they were thinking it was overvalued or there's risk. There's no risk to American Tower Company. As long as we are going to continue to go through and make everything attached to the Internet of Things, then there will always be demand for spectrum, right? All these little EV cars that you're gonna put with Tesla chips, all this chip shortage, all this stuff that's going on, the reason it's going on is because increasingly companies like Tesla, companies like all that data has to go up into the air 5G side and then somehow magically make it to a company. And that means that there is limited to no risk of American Tower's earnings. Now, they do have a bunch of towers, and they have absolutely grown overseas, and that is part of their strategy. Still, those countries as well are trying to increasingly go overseas. And it turns out one of the things I've always loved about the tower business, for better or for worse, is there's a concept of not in my backyard. And so the moats around companies like American Tower are quite large. Currently, it trades at 42 times, which you'd think is a lot, except that it actually grows its earnings over 55% and will continue to do so. And there is limited to no risk that they will not get their occupancy rate, is how you would think about it. So American Tower is one, you don't play with options on this one. This one, you just buy for the dividend yield and then any price appreciation that comes with it as they just do their thing. Other companies so Applied Materials to me also makes no sense that it trades at 16 times right now, because there is a cognitive dissonance between the largest equipment semi-manufacturer trading at a discount to its growth rate. Oh, excuse me, this is not showing correctly, hold on. Right, it's growing at 51%. That's not a joke, a one-off quarter thing. As long as Intel is going to increase the number of fabs, Intel, Taiwan Semi, and a couple of others are growing fabs and creating more factories. Fab is just fabrication, plant is what that stands for, or I like to call it fabulous because I'm long those stocks. As long as that is continuing, then this 50% will continue. And like the competitor, some of the competitors in this space that do similar stuff all came in better than expected by a lot. So one of the things with the volatility in the market is sometimes if you just back up your options for the full year, you'll see slightly less volatility than the front of the options. So even though I expect Applied Materials to have a great quarter, I expect this 16 and a half times to look like 8 times if the market doesn't want to move this stock, because I think that they will in fact continue to grow earnings aggressively in the fourth quarter, especially since the fact is, since the fourth quarter, Intel has reported that it's going to open a plant in Ohio on top of everything else. So, this just doesn't make any sense. I prefer to do it and just go ahead and lock in some long-term, like longer out gains and stay out of the way of this volatility. I like to do it back in May. To do the May calls, you can do this. If you want to go farther and go to January, go for it. But you can do these for like $8 for a 25-point spread, which would give you $16.50 if it goes even to like fair value. Not even if it goes back to the valuation it had when it was still undervalued. And then notwithstanding any benefit they do for the quarter, you would get like 194% return on invested capital in 108 days, which is well over anyone's return desires as far as that goes, in my opinion. Currently, it's trading at 140-ish. Break even would be 148.50. I really would recommend this. Some of you guys also play options in your own special way. Do it however you like, but I would be shocked if Applied Materials really does trade down into earnings, maybe I would buy a put just to hedge off this longer term position, but I would want Applied Materials, AMAT. If AMAT somehow, I'm just saying this one is cheap. It doesn't make any sense. So that's what I'm there. Here is when it was trading at 138 this morning, you could get it done for 828-ish, 838, something like that. That's what it looks like that way. So, Applied Materials, I'm very bullish this one. I think it's really coming up for sale. And then there are two companies where I'm really surprised at how well. Okay, so Clorox is one that is held up like a champ, okay? Clorox trades at 30 times earnings. It has basically crapped out the quarter for the last 3 quarters, and the reason it's doing that is because this is the price of chlorine. And let me tell you about the price of chlorine and why it's going up so much. Number one, there was huge demand into COVID, and that absolutely helped Clorox in the first year of COVID have like folks buying Clorox like crazy. But let me tell you what also happened. A bunch of people moved from the north to the south, and when they did that, they also bought pools. And the pool business has been in fuego and driving additionally up the price of this demand within chlorine. And so basically, whereas Clorox and, it just like the bet that you have if you're still long Clorox right now is they're getting significant pricing. So this is like a 23% increase, that they're getting significant pricing and volume relative to 2020. And I think that's an aggressive call, especially with valuation at 30 times forward earnings, 47 times trailing earnings. So this one you can consider buying puts on or put spreads on. I didn't have time to show you how you might do it, but I would look at it from the 165, 155 level and see if you can get that for under $3. And I would give it a few weeks so that you have some time to cover it one way or the other. I wouldn't do it too aggressively because for whatever reason, sometimes the market thinks of Clorox as like a defensive play. Let me explain something to you that drives me absolutely crazy. This wholesale thinking that consumer products, consumer staples are defensive is nonsensical to me when they are trading at a multiple that they have never achieved, except in the first moments of COVID, right? Clorox does not historically trade at a 30% growth rate. That's insane. So yes, it is the case that the markets love to be extremely bullish on the defensive names when they get concerned on market volatility or they think there's going to be a downturn. But let's call this what it is. It's bleach, guys. Do you know what I'm saying? It's cleaning products. And I think people have bought what they're going to buy in the way of cleaning products at this point for the last, if they were going to stockpile them. So just kind of take a note of that. Clorox to me is a short. And then the final thing I have prepared, David, you pinged me and asked me to just do a little bit more on PayPal and why I was very much so after last quarter ready to short it, even though the market went up a bit and then it's danced around. I wish I'd actually held my short into the quarter because obviously it didn't do so well, but I would actually be okay putting on more shorts, possibly today, possibly after today, because this quarter, I mean, I got to give this CEO credit. He absolutely came out like a champ, talking like everything was great, but this was not a great quarter. Let's just call it what it is. You know, here's his quote: 2021 was one of the strongest years in PayPal history, and he focused on volumes. Okay. I am focused on making cash money. That's what I'm focused on. I'm an equity holder, right? I need you to actually bring all those volumes down to the bottom line. You're not a startup. I need you to actually make money for the shareholder, right? That's what we need you to do. If you were like a 5-year-old company, a 10-year-old company, cool. I can just believe magically that operationally we can reduce some costs there, get economies of scale, et cetera, et cetera, et cetera. But what you're essentially telling me with these numbers is that you are not getting economies of scale, right? You got 17%, 13% top line growth on the quarter, and you decreased your earnings per share by 49%, or if I use GAAP, which in fairness, they do have some things because they have discontinued their relationship with eBay. And so he talked about the fact that that kind of sucks to be him because he has to deal with that on accounting side. But even non-GAAP, which would be an adjusted number, is only up 4%. So you had your record trading, you had your record transactional volume, you grew the top line by 13%, you grew the bottom line by 4%, hence you are not bringing it down to the earnings line, which is what I care about as a shareholder. I'm not cool with that because you didn't describe in there some magical CapEx that is actually driving the difference between 13 and 4 that's going to drive shareholder value in the future. That's not what you talked about. So that's my number one issue, is the difference between earnings growth and revenue growth. I haven't seen it for 2 quarters, and I'm not hearing why that makes sense. He seems to be focused on the calls on volume, which, heck, if I was in his shoes, I would also be focused on volume because that is the beautiful golden point of the call. But profitability is a problem. It's a problem. I mean, even though, and it's weird because you see, you know, on a non-GAAP basis, on a GAAP basis, because he's getting rid of the less profitable eBay business, it's 9% on GAAP. 0% though, after I take out essentially everything that's going on with the eBay stuff. So no change in operate. It's the weirdest and hard, and even worse than that, even worse than all of this is, number one, I'm still not hearing a great strategy for the post eBay period. Number two, he still only has operating margins in the teens relative to literally every other credit card company, which will have operating margins in the high 20s to even over 60%, such as Visa and MasterCard. And then even more than that, you know, I don't get it. I don't understand why people like this. It's trading at 30 times. If it traded in line with its earnings multiple, or even, I'll give it to you at revenue, right? It would trade at 13 times. That would be the right number to give it. And then you're just totally at that point giving him credit that he'll be able to bring it eventually down to the bottom line. At 13 times, the PayPal is worth half of what it's currently worth. So interesting. Just want to throw it out there. Not a huge fan of PayPal, as I've been for many quarters, but people do love to love this name. So it is not the easiest short out there. It's not the easiest short out there. I usually do it, make a little money, get the F out is what I do. But at 130, if you really want to do it, you don't have to necessarily do it today. You could do it later if this thing starts to correct over 130 back towards the 150 level, because sometimes you do get a dead cat bounce. But you can get it for 280-ish. Your max profit looks like this, and that would be down another 6% from where it's at. One of the reasons you would put it on today is because this thing rallied to 170. So there are some people that need to get the F out of this right now. So it would just be folks covering their long position or trying to punt out a long position on the option side that is close to zero in value at this point. So I would just mention that. And
may I
Yeah.
let me just
What you
say
got?
something. You've been bearish for several months on PayPal. I mean, it's not just this
Yeah.
last earnings report. I think
Yeah. I mean, this
even
report didn't do
before
it.
the previous earnings report, I mean, it was in the 200s, and that's
Yeah.
what I was asking. That's what I was alluding to.
Yeah. Oh, cool. Yeah. I mean, I saw the same dynamic when they reported. So when they reported last quarter, they traded down a touch and then traded up. And I was like, what the F is going on here? This is crazy. And I noticed that like everybody was like, well, PayPal has a moat. PayPal has a moat. And I'm like, what do you mean PayPal has a moat? Visa has a moat. MasterCard has a moat. PayPal has no moat. If anything, PayPal has first mover advantage, not the same as a moat. Okay. A moat is a business model that no one else can recreate or otherwise come across. And if you really had a moat, you would have something higher than 15% operating margins because you'd be able to charge whatever the hell. The fact is, Square competes with them, Shopify competes with them, every little small company that's doing one piece or one sliver, even Western Union competes with them at this point because Western Union has actually built a front end to try to deal with cross border payments. So, like, they have the opposite of a moat, in my opinion. They have exactly the piece of technology that every other fintech is trying to do aggressively and build out aggressively to help people with whatever part of the payment stack that people would like to do. So I'm actually really shocked at all of the analysts that keep coming out and talking about how PayPal has a moat. I don't see it. I see first mover advantage every day of the week, and I'm not saying that PayPal is going to zero. It will not, because all it really takes is for them to do a number of, but they are going to have to acquire their way out of this, in my opinion.
Well, I think they have so many users, and I think they were comparing like these Kramers of the world, even the guys on Fast Money on CNBC were comparing it to what American Express had done or Visa had
No,
done, right?
that's a misunderstanding of
Okay.
thank you for sharing that with me because that helps me clarify why these people don't understand the difference between American Express, MasterCard, and Visa and PayPal. Here's the thing. Back in the day, everyone here that has a little bit more gray hair knows of this. Like if you went to an ATM overseas in like, back in the day, you would have had to look for a symbol called CIRRUS, CIRRUS. And what that represented was Visa and MasterCard and American Express going around the world making arrangements with different countries for cross border transactions. Okay? PayPal does something different to manage its cross border transactions, and that's why there's no PayPal ATM situation happening. That moat that was built back then that allows you to take money out of literally every ATM on the globe, that's a moat because that took a decade to build. PayPal doesn't have that. They're going to have to acquire that if they really want that. And there's really no one to acquire it from because the three companies that have that moat, Discover to a lesser extent has it as well, to a much lesser extent because it's the number of countries, right? Um, pay, yeah, is the answer. No is the answer. But what they do have is a transaction system that and a float attached to it, right? So like when I'm buying something from China, I can use PayPal. There's a float in between the days to clear that. In some cases, PayPal just absorbs the float. And in other cases, they make you wait 5 days, depending on what country you're in, just like Western Union does. But
Okay. Thank you very
I
much.
would
Yeah.
say that
I just want to reiterate that how many experts were so bullish PayPal, and you were like, no, 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 and
yeah,
that's excellent. I'm
I
commending
appreciate
you.
that, David. I appreciate it. And, but I will say that where they're right is that PayPal has first mover advantage. Like most people on the earth have a PayPal account. Not every, because of the way that Square has built itself, not everyone has a Square account and not everyone will ever get one, especially if you're overseas, right? So there's that. That doesn't mean that like, you know, so how do I say this? Like the challenge is that PayPal's in the running with every other company that does what it does in its local area. So like in oddly enough, PayPal is one of the U.S. Fintechs that does actually have the ability to do cross border and actually has huge presence in a lot of different countries because people love to sell to the United States from their local area and do it that way, whether it be Canada or otherwise. Their separation from different retailers let's just put that to the left. But that's why I'm saying like Shopify could easily come in there and take care of it because they have kind of similar transaction payment processing situations. Um, you know, Alibaba with its payment, although I don't think the US will ever really truly allow that. Do you know what I mean? Like all of these other competitors are absolutely competitors to PayPal. I think PayPal with first mover advantage will be great, but I think what hasn't been taken into consideration by any of the analysts is what do you pay from a market cap basis for a company that seems to be having about a 13% operating margin and will have to likely spend its way to generate economy of scale going forward, essentially. And I don't know the answer to that question in 2022 when I've got a bunch of companies that are actually growing top line and bottom line really, really well. And that's not stable. I think sometime in the next 6 months, people will realize that PayPal actually has to be a turnaround story. And the story is going to have to relate to number one, what does PayPal do once it's finally completely free of the accounting stuff from eBay? Even without the accounting stuff from eBay, what is the profitability of it? And then all these acquisitions, what do they actually do for the bottom line? Thus far, I don't see it.
Thank you.
Yeah. Cool. Any other questions? Sorry. All right, everybody's really quiet today. We still have a couple more days of earnings, and next week will be quite a fun week of earnings as well. Wow, what a crazy market. I'll go ahead
The
and
Robert
end.
Half's moving.
Oh my God, did I hit the, I hope I hit the record button. I did, right? Oh my God. Oh, yes, I did. Good. All right, past performance is not indicative of future returns, as we always say. And until next time, I will see you guys. Take care.